Okay, what is a liquidity sweep and inducement? So I'm going to go through what an actual liquidity sweep is and inducement, which is almost fuck. It's almost like a manipulation of the market. So the market movers will um, kind of fake a move and they'll push it up or down again to stop a lot of traders out so they can push it even further because obviously to buy a position someone has to sell and to sell a position someone has to buy. So we're going to go through it. Um, uh, I've been staring at the screen for too long today, and fucking, I've done so many notes on my journal to trade in that my whole thing has gone black and shit. Okay, so let's get on to the charts now. I'll also go through other stuff as well in the market today as well. So I did clear all my shit. Ah, come on. Okay. So obviously, yeah. Right, we'll go for this because this is something I saw and it might help. So obviously, there's an imbalance here for fair value gap on the 1 hour, and then there's also an order block here with a strong displacement candle because obviously there's a fair value gap. So then price went down. My daily bias was already bearish because obviously we're in a huge hourly bearish trend. So I waited, I entered one position as that one got filled, fair value gap, and then I entered my second position here at the order block, and then obviously we see prices just smashed downwards, which is mental. So yeah, we're going to go through the liquidity and inducements, and we're going to try to find a good example of this. I'm going to go on the 15-minute, see if I can find something. So there's many different ways that you can use liquidity sweeps, but this is one of the stronger ways I think. Because what the fuck's wrong with my? Okay, yeah, so this is one of the stronger ways that I find, because it's kind of the market makers are manipulating the market, so they will. Okay, let me just. I'm gonna draw it out here. Yeah, that's me. So, all right, let's. Oh, this is fucked. This is why I fucking hate doing this shit. Okay, so all right, so we have a high here. We have an equal high here, like that, and then say we have like some sort of fair value gap here, maybe a small bullish fair value gap. So it goes down a bit, and then it breaks structure underneath this. Maybe it comes up again, and then this will make all of the people selling think that price is going to go down straight away. So what the sellers will do, they will place their stop losses around there. So that's where their stop losses will be above these equal highs, or maybe perhaps off here as well. That's where it will be. So what price will do, it will come up, and then people think, oh shit, now it's bullish, and then it will do the real move. So obviously sellers need someone to buy, especially the big traders, smart money, whatever you want to call it. They need someone, people selling, they need someone to buy the position. So whether that's people's stop loss or people's entry points, these need to be filled so they can move the market. So they will manipulate people into thinking it's going to go down, so they'll sell, but the stop loss is there. Then it's going to go up. Okay, shit, buys are going to put their stop loss under there, goes up, sweeps the liquidity, and then smashes back down. And that's essentially what it is. So it can look something like this. It doesn't have to be equal highs. It can be different. I'm going to try find an example on gold because I mean it's see if there's any bearish ones. because I don't think gold really works off this much. I haven't seen any because it's quite gold doesn't really trend very well. What I find recently anyway, it's kind of been very choppy and shit. Obviously because of the whole war stuff that's going on. So, okay, we'll start with this. See if this could be something. So we have a low here. Price goes up. Okay, so clearly there's been a reaction of this. So now people are thinking, okay, I'm going to buy with stop loss under there. Markets come under here, sweat the liquidity that's lying underneath here where lots of stop losses would be, and then you see, bang, straight away it goes up after sweeping liquidity. And that's one example. Obviously, it's not going to look exactly that clean as I drew it out, but you can definitely find examples, and this is one of the really strong confluences as well. So using this is actually one of the strongest ones, especially like it sometimes will override like fair value gaps as well, depending on how strong it is. Stuff like this. This is just the way I like to explain things, you know. So let me see. And I'm not guaranteeing you it's going to work every single time. This is how I learned it. This is the way I look at it. This is the way I see it. So, right, we have a high here. We'll make it green actually. High there. We have stop losses there. That's where people place their stop losses because it's been a reversal. So they will enter there to go short. Stop losses will be there. Price reverses again. It takes out all of those stop losses, all of the orders, it fills all of them, and then price can continue even lower. And that's liquidity sweep, inducement, whatever you want to call it, almost manipulation. So say this, obviously this is the 1 hour, so this is probably over the course of like 2 days. But if this was like the 5 minute or something, imagine this. So we have a high there, price goes down. Actually, no, up, stop out all of these orders because a lot of the people that are going to be going short, they're going to target the most recent low or high. So a lot of the people going short, they would have targeted their take profit to be there. They may have even targeted their take profit to be down here as well. So basically, yeah, what price has done, they've entered there. Oh, let me just. They've entered there, right? We've just seen a break of structure. That's a low. That's what they've entered. Let me just change the color. They all look too similar. They've entered there. Stop loss is there, above the most recent high. And the take profit's there, most recent low. Price has gone down. Oh yes, it's going to hit take profit. Actually, no. We need a stronger movement. So they're going to go up here, fill all of these orders, and then they're going to push price all the way back down. And then if you look here, price would have hit these most recent lows. See, both of them get hit. So this is kind of like a manipulation in the market. So a lot of the smart money or these big industries and banks and stuff, they will do this to kind of catch you out, so they can use you as liquidity, so they can fill all of their orders and then they can push price down properly. So that's why sometimes I like to have a larger stop loss, or like especially if I know it's pretty good, because obviously we've got fair value gaps here, fair value gaps there, highs here, and we know these will produce reactions. So sometimes I do like to extend my stop loss a little bit just to allow for this to happen. So we'll go down. I've already explained it clear enough. I'm just trying to make it as simple as possible. So I'll explain it one more time. Obviously, we make a high here, break of structure, people enter, they put their stop losses above highs, price goes down, they're going to target here and here as they're the most recent lows. smart money will want to push price up more so they can fill more orders, stop you out, and use liquidity, take your money. So they'll sweep the liquidity, enter all of their sell positions, and then they'll push price all the way down exactly to where you targeted your take profit. And that is literally it. Obviously, there's other ways of finding liquidity, like session highs, session lows, which I will go through eventually. But this is kind of like one of the best ways I like. So either equal highs, which is a good one, or you see one high get made, and then we know that it's very possible for price to want to fill more orders. So it's going to go up, sweep liquidity, take your stop losses out, get you out of the trade, take your money, and then they're going to push down to exactly where you had your take profit. So a way to kind of look around this and to avoid this happening to you is by either, depending on how you like to trade, either have your stop loss further up here. So obviously we see there's a bearish fair value gap right there. So personally, I would have had my stop loss maybe up here or something, because I know that there's going to be reaction at the end of this fair value gap, and it does look like that this was sort of a reaction of it. So I would have had it up there. And this is because I don't like having it above highs or above lows, because gold loves to liquidity grab. It will take all your money, take your stop losses, it will hunt your fucking stop losses. So it's best to have a safer stop loss. And by entering these, you can either enter off here. So obviously it hits the fair value gap. We see a reaction breaking structure. You can either enter there, put your stop loss there. Then you see price come up again. You can either enter another position at the end of this fair value gap, or you can enter another position 0.5, so maybe midline, and then you can target these take profits down here. And that's just a simple way you can use it. And I hope this gives someone a good idea of how it works. It might make it simple. It's better to look at someone else's video who's more experienced than me, because I'm not that experienced, but I do know a few bits on it, and this is just how I view it. I do a lot of work on all of these confluences, and I do a lot of research on them, so I do know how it works and a lot of the ways how the market likes to move smart money, where smart money wants to buy, and obviously you want to enter within equilibrium. And I think I made a video on equilibrium as well, so watch that if you don't know what that is. I also have a fair value gap video, order block video, stocks and shares, break of structure. I think I've done a lot of videos. So I'm going to do another one probably tomorrow. Let me know what you want to see, because I can go for anything. I'm starting to run out of ideas now for trading. And that's it. If you like the video, comment what you'd like to see next, or comment if it helped you. Like, subscribe if you like trading content, and I will see you tomorrow.